Hi guys, welcome back to our YouTube channel AlgoWise. My name is Kalyan. So people who would have seen our last videos related to macroeconomics, the basics of macroeconomics, we covered some of the topics in detail. And there was also a third video, which was like the current scenario in the Indian stock markets as well as the US stock markets. So I have shared a link in the description of this particular video in case you have missed those. So mainly for today's video, we'll be covering the US inflation data, which had come yesterday, and then this data is really important for everyone because it will have a direct impact on the stock markets, the US stock markets, and simultaneously it will have a bearing on the Indian stock markets and elsewhere. So we have Pratik who would be explaining in detail about that. Pratik, yeah, let's go ahead.
Yeah, hi Kalyan.
Hi.
So we had a very important data release that basically came in. Everybody was looking, the entire world markets are kind of looking at this data. This is the US inflation data, the US CPI data, which had basically come in yesterday. The expectation of the headline CPI, which is the overall CPI, was around 8.8%. Last time it was 8.6% last month. So
Okay.
the expectation was around 8.8%, but it actually came in at 9.1%. It was above expectation. And a lot of components basically came in above expectation. And even the core inflation, which was 6% last time, and the expectation was around 5.6%, but the actual core inflation came in at 5.8%. So now what is core inflation? Core inflation is just the inflation excluding the more volatile food prices and the energy prices. Excluding those two, whatever inflation comes in is basically core inflation. So core inflation is quite sticky. At the same time, we have got an inflation of the US, which is kind of quite high. Let me share my screen and I will show you what exactly happened in that data and what are the implications really, right?
Yeah, please
So
go ahead.
Sure. So if you look at this data, right, if you look at the overall inflation data, this is the chart, right? You can see all items basically came in at 9.1%. Food came in at 10.4%. Energy was pretty significant, 41.6%. This is the year-on-year number. This is not the month-on-month, but year-on-year numbers basically.
Okay.
Right. So from last year, energy prices went up by 41%. So this is one of the major drags on inflation also. All items excluding food and energy, which is the core inflation, which I mentioned, right? This came in at 5.9%. Let's look at the components of
So
this also, right?
year-on-year data means last year's 2021 June data if you compare with 2022 June data, right?
June
Year on
data,
year.
yes, exactly,
Okay.
exactly. So basically 1 year's change in the inflation, basically
Correct.
1 year's change
Correct.
in prices. So if you look at this, if you see the core inflation part, all items less food and energy, that is also significant, like 7.2%. Services less energy services, that is also 5.5%. In US, Fed has a mandate of keeping inflation at around 2%, basically. So if you look at each of these numbers, these are quite significantly higher than what is expected, right? So if you drill down the 5.5%, shelter, this is one of the major components, like 32% is basically this component of shelter. And associated services, if you add that, it will become around 42%, right? So this is very significant component of the inflation basket, basically shelter, that is growing at 5.6%. Last month, it was lower than this, around 5.4% or so. Medical services
So
are
stopping
also...
you here, a shelter is exactly, are we talking about the real estate part or?
Real estate, yes, yes.
Correct.
So
Yeah.
if you look at shelter, see, there are two things: rent of primary residence, right? So this is rent of primary residence. This is one component, which is 7% of the inflation, total inflation basket. The second is owner's equivalent rent of residences, which means that suppose you have bought a house and that house has an equivalent rent, right? So whatever rent is basically there, that will be added to the GDP or added to the inflation basket. And whatever rate it is growing at, that will basically also be reflective in the inflation numbers, right?
Okay.
So it's not just the rent which somebody is paying, but it's also the owner's equivalent rent of residences. These two components make up shelter, basically.
Okay.
Then there are some other services which comes under real estate, which is like your let's say you buy a bed, you buy a sofa, you basically do some other services associated with housing, right? For example, you pay your utility bills at what rate, at those increasing. Those are additional component, but shelter is just these two components basically. And
Okay.
these two, if you see, it is totally adding up to 32% of the total inflation basket, which
Okay.
means if this is growing at 5.5%, your headline inflation will be impacted by 32.32 into 5.5. So
Correct. Correct.
approximately
Yes.
1.6% will be directly impacting the CPI number, the headline CPI number, right? And this one important thing is that shelter has been increasing consistently over last couple of months, basically. So that is the problem that we are kind of facing right now. So if you look at the monthly numbers, these are the monthly numbers, right? Monthly numbers means what is the month-on-month rise. If you look at shelter from December 2021, 0.4, 0.3, 0.5, 0.5, 0.5, 0.6, 0.6. So the trend is on the rising side, basically. And if you look at the year-on-year data, it is 5.6%. But if you see month-on-month data also, it is sort of on an increasing trend, which is little worrying for the headline inflation number, right?
Yeah.
Again, transportation services, there are a lot of transportation services that are also increasing at 8.8%. This is also, this does not contribute a lot, around 6 to 8% basically.
To
But
the
if you include
basket.
the to the basket, yeah, but if you include the new car prices and the old car prices, the overall transportation will become much higher. It will be around 16 to 18% of the overall inflation basket, right?
Okay.
So this is also an important component, and that is also increasing quite significantly, 8.8%. You see, when you compare it with the 2% target of the Fed, it is quite significant
Yeah.
over
Yeah.
here.
Yes.
So this is how it is sort of happening. If you look at the numbers, it is not really looking good. And because of this, there is something called as a Fed fund rate expectation, right? What is Fed fund rate? It is basically the rate. It is basically the overnight lending rate of the Fed, right? So
Okay.
that rate increases or decreases based on whether Fed wants to hike rate, or they want to decrease the rate, right? Like we
Typical
discussed in the
what the
older
RBI
videos.
does in India.
Exactly, like RBI, the repo rate. Similarly, we have the Fed funds rate.
Okay.
At what rate Fed wants to lend out, basically, or
Correct.
what rate
Correct.
it wants to maintain for the interbank lending, right? So based on that,
Yes.
we have a Fed fund rate. Now the Fed fund rate is now at 1.5 to 1.75%. That is the range. It basically stays in a range. Now
Okay.
the initial expectation before the CPI release was that 75 basis point increase will happen. That is 0.75 percentage increase will happen to the basket, right? But now the expectation went haywire. In fact, the expectation is now that there is a possibility of 75 basis point, and there is also an equal possibility of 100 basis point, almost equal possibility of 100 basis point, which means the rates might go to 2.5 to 2.75%.
So Canada has
And this
already
is
done
going to,
that, right? Like they increased from 1.5% to 2.5%. Straight away, 100 basis points increase. Yesterday, this was the news.
yeah, Canada has also done 100 basis point increase. And US is also supposed to, I mean, not US, but the Federal Reserve of the US is also supposed to do that. I mean, there is a good enough probability that that may happen. Now, there is a lot of implications of basically rising rates, because if you look at the last 10 years, we had very stable sort of rates. I mean, rates were either at 0%, or it was basically between 1% to 2% kind of range, right? The federal funds rate, if I just show you federal funds rate, right? Then it's always uh, been on a slow trend. If you look at the last 10 years, this is kind of very long period of time. But if you look at 10 years data, you see it basically was at 0%, effectively at 0%. It basically went up maximum up to 2.4%, right? In June or 2019, mid of 2019. Now we are talking about by 23rd of July, which is the next meeting date, the Fed is going to increase. I mean, this is not showing the full data. In fact, I mean, it is even higher right now. It will cross this peak basically
Okay.
of
Okay.
2019. That's what is
Okay.
expected. Now, inflation never has been in such kind of territory for the last 41 years. It's it's a long time period. So what if the Fed increases much further? I mean, 100 basis point is still fine for one time, but what if the the rate increases continue? Every time we are expecting that Fed will be fine, inflation will basically come down, inflation has already peaked. Every time we are expecting this in every data release, but it's not just happening. Energy prices are coming down, I understand that, at this point of time, because if you see oil, for example, if you see oil has come down quite significantly. You see this,
Yeah,
Brent
yeah,
oil
yeah,
has come down from 140 to around 100 levels.
yeah,
So
yeah,
although
correct,
oil has come down, because of which the energy inflation might actually come down, but we have got other components of inflation. For example, we have got food, which is still sticky. Food may again come down, but again, if you look at the core inflation, which is all items less food and energy, even those are quite sticky at this point of time. 7.2%, 5.2%, 11.4%. What about this? And shelter, which is one of the major component, is also increasing quite significantly at this point of time.
correct,
So
correct,
this
correct.
can, yeah, so this is somewhat becoming sticky, and because of that the Fed might actually be very aggressive. Now, why am I talking only about the Fed? Because it impacts the entire global markets. If you look at the trajectory of US dollar, you see this is the US dollar, right? From April, look at what happened to US dollar. From February it was at 95, now it is at 108. It's continuously increasing. And whenever this kind of thing happens, we have got a lot of debt. Not only we, but many emerging markets have got a lot of debt which is denominated in US dollars, because US dollar is sort of a reserve currency, and
Correct,
people
correct,
want to take debt in US dollar. I mean, people want to lend in US dollars. Because of that, many emerging markets, whether governments or whether corporates of the emerging markets, have a lot of debt in the US dollars. Now, if the currency goes into tailspin, there can be a lot of tail effects. Like, these are called tail effects, which basically means that, let's say in Sri Lanka, what happened is that their currency went into tailspin. Their currency basically fell quite significantly. Because of that, they were not able to afford food, they were not able to afford energy like oil or other kind of resources. Then whatever debt they have, they might be defaulting on those debts also. So if this happens in multiple different countries, and different banks have got exposure in those countries, then it is going to be a bigger crisis than what we see in Sri Lanka right now. And that crisis can become basically global.
correct, correct.
And
Even if you see the depreciating rupee, so whatever energy prices has come down, crude oil prices come down, that is again offset by the rising, the depreciating rupee. So that has also, that will impact directly our country, right? That will have a direct impact on the markets.
yeah, to some extent, but I
Mm,
mean, rupee depreciation is not that significant. If you see,
mm,
we were in February we were at 70, I mean 72, 74 kind of range. We are now at 80 kind of range. We are
correct, correct. Yeah,
heading towards 80.
heading
But if
towards
we
it.
head much higher, then it will be a problem basically. Slow depreciating currency is sort of fine, because what happens is that then we can export more. The exporters will get some benefit out of it, and there might be, those benefits might actually add up to the economy. There might be some, you know, tail impacts to the economy, which is sort of in the positive direction, right?
Okay,
But again, if it depreciates too much, then what will happen is that we will have an import problem. We will not be able to import a lot of things.
correct, correct.
And those imports are really key to us, because we cannot live without oil, right? We have to have oil, we have
Yeah,
to
yeah.
have diesel. Those things run the country. Why? Because you will have trucks which will have to run from one place to another. If you increase the diesel prices too much, inflation will increase too much basically. And if you have a huge amount of inflation which is impacting the country, then you know what the problems can be, right?
Correct. And even in the consumer basket, which you just shared a screen and then you showed from the website, right? So even in the consumer basket, if you see the commodities, those are all, a lot of commodities would be interdependent on the energy basket, right? Because they'll be using for the transportation of it, it will be energy would be used for that, right? So some of the commodities would be interdependent on energy.
Yeah, that's right. So some of the commodities will also be interdependent. For example, new vehicles, the sales of them will be sort of interdependent on some sort of things, and there, let's say there are apparel that will have to be transported. Everything has to be transported, right? Whenever
Correct,
there is
correct, correct. So that's
transportation
what even
involved.
the food, or if you speak about food or food items, grocery items or staples, those need to be transported right from one place to another. So if gasoline is costing more, that will again have a direct impact.
Yes, yes, exactly, exactly.
Okay,
So this is not just about the US. Basically, it's now becoming about the global economy, and it is not that US will be insulated from the global economy. The reason is that if there are major defaults that happens in many of the countries, basically, let's say Brazil defaults and some other countries default, there are US banks, there are European banks who have got exposure in those countries, right? And if those exposures go bad, there will be a funding crisis in the market, which basically means that banks will not be funding to each other because they don't know what kind of exposure somebody has. And if that happens, the US economy goes into a bad tailspin. I mean, it can become a financial crisis. So that is why the Fed will need to be very, very cautious about what they are doing. At the same time, there are problems in the US state governments also, or local governments, because they have to borrow a lot of money to be able to pay for their services. But if they are not able to borrow, if the rates go up too much for the local governments, they will not be able to borrow. There will be a funding crisis over there also. So
okay,
a lot of things are sort of dependent over here, and if we do not get inflation under control very soon, uh, but if we cannot, see, there are two things. One thing is, you hike by 500 basis point, you will get inflation under control immediately, but there will be many other problems that you will create
correct.
by getting that
That
under
can't be
control.
done. Yeah.
Yes, yes. So you have to slowly get it under control. There has to be some luck involved over here. But at the same time, the Fed cannot be too aggressive also. If it becomes too aggressive, there will be multiple different problems it will create, which may not be solvable immediately.
Yeah, yeah, yeah,
But
correct.
for the markets, I would say that it's time to wait and watch for some time. Maybe if inflation has peaked, then the market will again start going up. But if the inflation has not peaked and the rate hikes are very, very substantial, then the market can actually be in a range, or it can go down significantly as well. So it is sort of a wait and watch. Nobody knows what exactly is going to happen now.
Okay, 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 okay. Okay, Pratik, yeah, I think so. We'll stop here. You have explained it very nicely, and so for our viewers, whenever some macroeconomic event which has got a direct impact on the markets, whether it's US markets or Indian markets, we'll explain that scenario, so that it'll be known by all and people can take decisions based on that. So this, like in the earlier videos, we discussed about macroeconomics, right? So this is related to this particular inflation data, which we consider as a macroeconomic event, and then so the explanation was based on that only. So in the next video, we'll come up with another event which has direct bearing on the markets, and Pratik would be explaining that too. So it'll be a continuous series. Yeah.
Sure, sure, Kalyan.
Yeah. Thanks, Pratik, for joining and giving such insightful details. Yeah. Thank you.
Sure, sure. Thank you, Kalyan, for inviting.
Yeah. Thanks, Pratik. Bye.